Entering the trade is easy. It's the exit that determines whether you survive as a trader. Today, we are exploring the reality of profit taking and strict risk management. We look at how to lock in gains objectively and how to use stop losses to protect both your hard earned capital and your mental clarity. So far in this short selling module, we have covered the essentials: setting up a clean charting template, identifying the right short candidates, including advanced filters like a declining short vote, and spotting the exact characteristics of final pre-entry rally. We even covered how to execute the short entry itself. Now in this video, we are focusing on the final piece of the puzzle: locking in gains and minimizing your losses. How many times have you entered a trade, watched it go up, and then hesitate to sell? Because trading, and short selling in particular, carries inherent risk, you must train yourselves to consistently lock in gains when you have them. If we are risking 5 to 6% of our capital on a trade, taking profits at 20 to 30% from a short entry create massive mathematical cushion. With a risk to reward ratio like that, you can actually be wrong 4 out of 5 times and still not lose your starting capital. And because stocks tend to fall much faster than they rise, a proper short entry will often yield these 20 to 30% gains quickly. Another key level for taking profits is when a stock undercuts a major low. While amateur traders often make the mistake of shorting at this breakdown point, this is actually where you should be covering your position. Instead of chasing price at the bottom, buy back your shares to lock in gains, and then stock the stock for the next high probability short setup. So far, we are focused on what to do when a trade succeeds and how to lock in profits. But what happens when a trade fails? Trading is purely a game of probabilities. You must accept that not every trade will work out. In fact, many won't. But if you strictly contain your losses to 5 to 6% per trade, risking only 1 to 2% of your overall portfolio, you overcome the biggest psychological barrier to long-term success. A reliable level to set up stop loss is 5% above the 50-day moving average on the day of your short sell trigger. This dynamic cushion gives the stock breathing room to absorb normal daily fluctuation without stopping you out early, while ensuring you are protected against a major breakout. Now let's talk about the bedrock of long-term trading success, the other half of risk management, more specifically position sizing. At the end of the day, how much capital you assign to a trade directly determines whether your portfolio survives a bad streak or gets wiped out. The golden rule here: never over-leverage a single position. Let's break down how to structure your allocation systematically. First, the learning allocation at 10%. If you are just starting out, or if you are testing out a brand new strategy or framework, keep your exposure capped at a maximum of 10% of your total portfolio per trade. This gives you enough skin in the game to learn without exposing you to catastrophic losses. Second, the professional limit at 25%. As your competence and consistency grow, you can scale up, but cap your trade allocations at 25%. Crucially, even with a larger position, make sure your actual capital at risk based on your stop loss stays under 2% of your total account equity. Final slippages and entry adjustments. What happens if you miss your exact entry line, say at the 50-day moving average, and the stock crashes down? Don't chase it with a full size. Calculate your distance from the original trigger and scale down your position size proportionally. That way, your dollar risk stays exactly where it needs to be. Bring everything we have studied together. Let me leave you with this: the ultimate strategy execution checklist. Think of this as your pre-flight routine before entering any trade. By combining profit harvesting with tactical risk control, you ensure that discipline, not emotion, drives your results. Before you pull the trigger, run through these 3 steps. Step 1. Size first. Always double check your position sizing before anything else. If you're still in learning mode or testing out the strategy, cap your position at 10%. If you're experienced and confident in the setup, you can scale up, but never exceed 25% of your total portfolio equity per position. Step 2. Place your stop loss alert. Protect your downside immediately. Set a stop loss alert on your preferred tracking app at 5% above the 50-day moving average, calculated on your short entry day. This ensures you are notified instantly if the trade starts moving against you. Step 3. Take profit. Don't get greedy, stick to the plan. Make it a habit to consistently harvest your profit once you hit the 20 to 30% gain mark. If you follow this 3-step checklist on every trade, you protect your capital on the downside and systematically build wealth on the upside. Now, to put this checklist into practice, let's do our usual end of video breakdown of the AppLovin short trade we have been tracking. App triggered our short entry, and as expected, the stock took a sharp dive the moment it reached its 50-day moving average. For this demonstration, I short sold 2 units of App using roughly 25% of our test portfolio's total capital. Here's how I executed the entry using a tiered approach. Unit 1. I shorted the first unit right as the stock reversed off its 200-day moving average. Unit 2. I added the second unit when the stock gapped down below its 50-day moving average in the opening minute of the trading day. Even though the 50-day moving average sat at $507 on the day of the breakdown, our average entry price across both units came out to $523. Following our exact risk management rules, stop loss alert set at 532, which is doubly 5% above that 507 50-day moving average key level. Take profit order, I placed a limit buyback order at $360, targeting a 30% gain, which also aligns directly with a major previous low. And that brings us to the end of our short selling module. I've attached a downloadable study guide in the description below so you can review these concepts, checklist rules, and execution framework at your own pace. I'll continue updating and adding more resources to that file over time as we refine this approach. As always, I'll keep you updated on how this AppLovin short trade plays out alongside new setups in upcoming videos. If you found this module valuable, make sure to like, subscribe, and leave a comment below with your thoughts or questions. Thanks for watching, stay disciplined with your risk, and I'll see you in the next video.